So let me next introduce James Longsdon, Managing Director and Head of EMEA Bank Ratings at Fitch Ratings. And I think you have some slides, don't you?
I do indeed have some slides, yes. So I will wait for those to appear on the screen. There they are, great. Well, thank you very much for inviting me to participate in this conference and share a rating agency's view on the outlook for European banks during this coronavirus crisis. We took a decision quite early on in the crisis to review pretty much all of our European bank ratings in about mid-March. And that really took place as the pandemic intensified and our own economist forecasts were rapidly being cut and progressively being cut as the extent and the impact of the lockdowns became clear. So we now actually see the euro area contracting by around about 8% this year before recovering 4.5% next year and sort of approaching 3% the year after that. So a very steep contraction and a relatively slow recovery, I guess, would be the way that we see it. If you move on to the next slide, this one here shows the rating actions that we've taken on our core Western European bank portfolio from mid-March. And I think this portfolio will be the main focus of my comments today, but it's certainly true that the comments I make hold true for banks operating in Central and Eastern Europe and Southeastern Europe as well, so please bear that in mind. As a result of the first round of our review, we downgraded, I think, really quite a small number of banks. It only numbered about 10. And these were concentrated on banks where a few of our sort of key rating expectations were just not going to be met anymore, in our opinion, because of the crisis. So, for example, where we have an expectation of NPLs falling or earnings improving, let's say, baked into the rating. The highest profile downgrade at that stage was of Commerzbank. Around about a third of the rating actions, so the red bits here, this is where you put them on rating watch negative. These were banks that we characterized as having a low rating headroom at their rating level. And usually that was coupled with a sort of above average, we felt, exposure to more vulnerable sectors or more vulnerable economies. So as an example, major banks we put onto rating watch there were BBVA, Barclays, Danske Bank, BNP Paribas, Nordea, for example. A couple of them we've already gone back to negative outlook. Danske and Deutsche we've already put back to negative outlook. And around half the rating actions, which I guess is the orange bars here, these were negative outlooks. So these were assigned to banks where we felt they had more rating headroom, but clearly the sort of severity of the crisis that was unfolding presented risks to the ratings over a longer term, shall we say. And that really was as the either under our baseline scenario, that the economic outcome that I outlined earlier, or of course under the event that we hope doesn't happen, where lockdowns are reimposed and we get a second wave of infection and the economic impact is even worse. So it captured those sorts of risks. If you move on to the next slide, and bearing in mind, I guess, the topic or the subject of this section of the conference, I think this slide speaks best to what is the defense of banks to the pandemic, and my esteemed earlier speaker picked up on this as well, but here are a few numbers to elaborate it. So the blue bar is the development, and it's using, with thanks to the EBA for their excellent risk dashboard data. So this uses the EBA risk dashboard. The blue bar is the fully loaded common equity tier 1 ratio development for banks that account for about 80% of the EU banking sector. So it's a pretty good portfolio. And you can see a pretty significant improvement from below 12% up to around about 15% now, CET1 ratio. And that isn't, and people often sort of say, oh, that's just mathematical trickery. It isn't mathematical trickery. That genuine is improvements in solvency. I think the numerator in the ratio has gone up by about 25% over the time, and the denominator fallen only by about 5 or 6%, something like that. So that's a genuine improvement in solvency. But I think also at the same time, if you look at the red bar, we've overlaid impaired loans. There's been a very sharp reduction in impaired loans. They've halved over the period to less than 3% now. And that's a pretty good entry point, I think, to go into a crisis at that level of NPLs. Now, clearly, some parts of the region, particularly in southeastern parts of Europe, the NPLs are a lot higher. But as a generalization, the NPL situation is as good as it gets, I think, entering the crisis for large parts of the banking sector. So that's a pretty good first line of defense. If you look on the next slide, though, you then get what I would call the If that was the good first line of defense or second line of defense, the first line of defense isn't in such good shape, and that, of course, is earnings. The banks in Europe really have, really on the whole, pretty chronically low earnings, we think, as a sector in total. The weighted average return on equity at the moment is less than 6%, according to the EBA sample. And here's a selection of banks, around that average. So that is clearly a weak first line defence when we expect loan impairment charges to pick up quite significantly, as they did in the first quarter. And the reason for this is a combination of factors. Low interest rates, certainly. I think banks have probably underestimated how much cost cutting they need to do. They've constantly been trying to cut costs, but then incurring extra costs related to compliance or digitization. So I think ultimately, the cost income rate has hardly moved in the last 65%. I think the pandemic will force banks to take a long, hard look at their business models. They'll look at their use of real estate. They will certainly make further inroads into their cost bases, I think. And maybe it'll be a trigger for more M&A in the banking sector as well, I believe, as to create greater economies of scale. If you move to the next slide, my penultimate slide, and this is kind of a segue, I think, into my what happens next then for the ratings perspective, but particularly as the second quarter earnings looms. This is a selection of the largest banks, and it looks at the loan impairment charges in the first quarter, the orange dot, comparing that relative to the last 5-year average, the little green cross, and the range over the last 15 years. And I think what's striking is that it varied really very considerably bank by bank in the first quarter, which isn't really surprising, given the quarter came what I would say at a particularly awkward point in the crisis, where the trajectory was very uncertain, the mitigating factors of government support hadn't really been fully weighed out yet, and banks was basically struggling to calibrate their IFRS 9 models to take into account that. But what we can see certainly is a very different picture. I think quarter two earnings, which have just started with some of the Nordic banks, they will be somewhat informative. We'll certainly get a better picture of what revenues look like in the second quarter, because they will be actual numbers. We should, though, get a little bit more evening up and perhaps slightly better modelled outputs for the IFRS 9 provisions. So I think that'd be what we'll be looking at. But we don't expect real asset quality, actual loan losses, to pick up really for several quarters yet. And so when the economic downturn, I suppose, genuinely bites and we get impaired loans. So if we move to the next slide, we've got a weak first line defense, a strong second line defense. What does that mean for ratings? Well, if you look here, this is the stock of our ratings. It tells you where we are now in terms of outlooks and watches. Since the first round, we've downgraded a few banks in Italy, following the downgrade of the Italian sovereign rating. A lot of them are back now on stable outlook. That's the blue bars, if you like. The downgrade of the Italian banks did indeed trigger a downgrade of a number of subsidiaries of UniCredit and Intesa in Central and Eastern Europe as well. I think I'd like to make the point, we do see, and this is a point that I think is interesting from this crisis, we do see the sovereign bank nexus is still very real. And we certainly see increasing sovereign indebtedness that's arising as a result of the crisis as a potential channel of risk for banks over the next year or several years. I think that's most relevant ratings-wise for banks that are at or close to the ratings level. And we've had one or two more downgrades as well. Societe Generale, we downgraded BBVA. But if you just look broadly where we are now, we've got about 25% of banks on rating watch, about 60% on negative outlook. So a significant majority on negative watch or outlook. I think it will be several quarters before there's any sort of real prospect of widespread rating stabilization. And I think our view is that the risks are very clearly skewed to the downside rating-wise in the interim. And that's where I'll leave my introductory remarks and hand back. And then I'm ready to take questions as and when.
Thanks very much, James. That was really useful overview there.